officially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. Today, we are talking about how to actually preserve capital, turn equities into income, beat inflation in this economy. In this economy. I'm your host, Pablo Gonzalez. With me, as always, that a man that I affectionately like to call GC because he's got the genius concepts, because he generates cash flows, because he's a great co-host. And even though I'm mixing up all the words right now, his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
And with us, as always, the magnificent MTM. We call her MTM because she brings us the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
Good to have you on board, and good to have you all with us. We have an update to our usual thing that we're recommending here, and it hasn't changed. Still recommending the same thing. If you're feeling lost and you want to just catch up to the knowledge base in this community and just like be a part of it and get in on the inside jokes and become a rental property investing knowledgeable person, we got a class for you that we put together, and you can find it now at notyouraverage.com. Thank you, GC, for making it an easier read for me.
How about that?
I really appreciate it.
That's one way you should know that I love you.
You're a real giver. And tell them a little more, GC.
So this course is a great quick start guide for you, like we talked about, to get into the community, to get up to speed, but really to increase your knowledge of investing in rental properties passively. So if you're somebody who has been considering it, you've been thinking about it for a while, you don't know where to start, this class is perfect for you. Pablo and I built the class out over a number of months.
Right here in these seats.
Right here in these seats. There's 21 videos that take you all the way from A to Z of what it takes to invest in rental properties passively and to do it with success. And it's broken up into really like 5-10 minute classes. So super digestible, something that you'll really enjoy. And if you're somebody who may have rental properties, you might have your third property, and you love this asset class, you want to know what it takes to get to 10 or to 20 or to 300, this class works for you too. It's about scalability as well. So for those advanced investors, you're going to love it. So I hope you all enroll in the course. This course is selling for $997, right? $997. But guess what? For our Not Your Average Investor community, we're doing a little something special. So we are launching the course today, and we're going to take $500 off for everybody who is a part of the Not Your Average Investor community. Whether you're here live, you're listening on the podcast, there is a special promo code, and the code is it's not what was it before?
Yeah.
It was that crazy one back in the day. We simplified it. So it's just save 500. Save 500. You go to notyouraverageinvestorguide.com, put save 500 in the promo code box, and you'll get it for $497. And that is through July 4th. Cool. So hope to see you all in the class.
And you said that there's how many people have taken the course?
237. I checked the numbers earlier today.
You're going to be in good company. 237 Not Your Average Investors already spawned from this course. You could be next.
There you go.
Go to notyouraveragiguide.com. Make sure that you use the code SAVE500. And then you can just join us here live and be part of what, GC?
The roll call, baby.
We got Christopher Lee kicking us off here from Fernandina Beach. Chris, good to have you back, Christopher. We got our leadoff hitter,
John Henning,
batting second. We got the MVP of the community,
Mr. Lee Bishop.
We got Big Papa in the house. We love it when he calls it Big Papa.
Pops, how are you?
Throw your hands in the air for Gregg's father, Jay Cohen. We got Big Ern.
All right, Big Ern. Good to see you. Coming in early.
Ernest Alberly back in the house. We got the ringmaster in the house.
Andrew Barnhill, future guest of the Not Your Average Investor Show.
Yes, all right, man. That's right. He's coming in studio.
In studio.
It's going to be exciting. We got our regulars, the Rileys, Gary and Rosalind from Murrieta, California. Second family.
We salute you.
We regard you.
We regard
you. We regard you.
Get that. I knew there was something.
We're gonna get it. We got Layla Powell back in the house. Layla, good to have you back in here, becoming a regular. I love it. We got Stevie B, the early retiree.
I love that.
We got Lewis Hudnall from our favorite place to mispronounce,
California.
We got Laura Colby in the house. Laura, been here before. Love that you're making it a habit.
We love that you're here. I know it's not a new name, though. It's not a new name, but we love that you're here.
We know this. We got our favorite Pacific Northwesterner, Nadeem Shah, in the house.
With his trademark good morning, good afternoon, JWB fam.
Good morning, good afternoon. Good to have you in here. We got Not Your Average Guest checking in from the text with a Aloha Nui Loa. I would assume that is the legend
Could that be Zachary?
That's got to be Zachary.
Could that be
Zachary, good to have you in the house. We got Keith Janela, our friend from the meetup.
Nice to see
in
you.
Sunny San Diego. Good to have you back. We got a Feliz Martes, amigos. You know who that's from?
Bill Shields.
Billy Shields. We got the maven of real estate from the mountains of Colorado.
Miss Leslie Wilson.
Miss Leslie Nielsen, greeting us from Denver. We got Pop Pop in the house.
We got Big Papa and Pop Pop in the house at the same time.
Love it.
Love it. Man, you guys should be best friends.
Everett Shapiro, good to have you back, my friend. Who else we got? We got Tamara Gamison from Colorado Springs. Tamara, new name?
Hey, welcome to the party.
Good to have you. I love this. We got our favorite fee-based fiduciary financial advisor,
Kelly Barenbaum.
Kelly Barenbaum in the house. Kelly, good to have you as well. We got number one, Greg, the better Greg.
Greg Stone.
Greg Stone from New Jersey. Good to have you in here. What else we got? I saw somebody else I wanted to say hi to that I didn't want. Oh, you know what? We got somebody here from Homosassa, Florida. Marilyn Cotterman.
Yeah, of course. That's the home of the manatees, Pablo.
The manatees. We got Sergio Prieto in the house.
Go Gators.
Raiders.
How about that Gator recruiting, Sergio? How are you feeling about that, buddy? Gator football making a resurgence.
Feeling pretty good. We got the first family of the Not Your Average Best Show, Ken and Carolyn Moline, the patriarch and the patriarch.
We salute you.
Good to have you in here. We got Katrina in the house. Good morning. And Ken and Carol. Oh, is Katrina a Duchess as well?
Katrina is the Duchess.
Katrina is one of the Duchesses.
We love, you can never have enough Duchesses.
And our favorite name to pronounce coming in here. Into the night, Aaron O'Neill. Good to have you. All right, GC, let's kick this off, right? So again, you've been beating the drum, right? Preserve capital because the recession is coming, right? Mm-hmm. Like people are gonna lose parts of their portfolio as this is coming. Turn equities into income, scalability, risk mitigation, and beating inflation, which inflation seems to be coming down a little bit, right?
It is a little bit easier to beat inflation today.
Easier to beat inflation, but we still want to do it.
Still tough.
Still want to do it. Still want to make sure we're doing it. And as we thought about this, we realized that I made a couple. You know, I've built a portfolio of 3 rental properties in the last 3 years, and the first one, you know, took a little bit of like going not your average route. Second one, I went a little further down the not your average path.
You did.
And the third one, I full sent it.
You did. You
right.
Did.
And as we look at these decisions, we didn't have the language for it back then, but these were very much turning equities into income, preserving capital, and beating inflation decisions. So
100%.
We figured it was a good case study to break down. I, as a youngest child and a millennial, love attention. So I put you to work. You were the philosopher, you were the analyzer, you were the tinkerer to analyze some of this portfolio. So we're just gonna. It was
a labor of love, brother. It was a labor of love. I think it's really interesting to talk about because now we're 3.5 years into doing the show and 400 episodes or whatnot. And, you know, you and me are pretty much attached to the hip, but you know, in the beginning, I didn't know you. You didn't know me, right? You really didn't know JWB. You just saw my incredible volleyball skills one day and you're like, hey, listen, I want to work with that guy.
Sneaky athletic, I'm in.
But I remember our first conversations were very different than the conversations that we have now and the conversations we'll have here as we talk about your journey. I remember conversations that you would say, hey, listen, man, I don't really get why rental properties are that much better than other asset classes.
True.
Right. And then I remember something clicking for you. Can you kind of take people back to maybe what your headspace was when we first started working together? Right. And then maybe just kind of talk about that moment where it kind of clicked.
Yeah. This is the section of the show I like to call When Greg Interviews Me. So yeah, man, as you know, right? Like I just had an idea for a better way to do marketing. Right. And you were somebody that was receptive to it. Right. And the idea was, let's make a community because I really believe that people learn from people. People need to see others like them making decisions in similar contexts to them in order to get comfortable and trust and believe that it's for them. Right. So that is how all this started, not because I'm a real estate expert. In fact, I was very far from a real estate expert at that point. And I believe I'm a lot closer these days. That being said, as we started this stuff, I remember talking about private lending at 10% and these like properties that we're kind of like talking about that were at a 8-9% before we ever really broke in the idea of home price appreciation and all these different things. And I'm an evangelist, man. My superpower is that I fall in love with everybody I meet and I'm a good communicator. So I'm a hype man, right? So like, I'm immediately talking about like you and what we're doing and all this stuff and all these other people in our community that are building these portfolios to my buddies, right? And my buddies are, I have a bunch of like accredited investor friends that are either like big dog lawyers or like big dog IBM, engineers and stuff like that. I hang with really intelligent fellows. And as I was talking to them, they just kept punching holes on it. They're like, yeah, man, but like really, like I bought this like house in like, it's actually in the Bay Area. I'm Redwood City, California, man. Like I did it, I remodeled it, I had it rented out. The moment that there was a turn, I lost all my cash flow. It really wasn't like the taxable income kind of like really wasn't good for me, right? So like that was my buddy Chris Kraft. My other buddy Gilbert's just like, yeah, man, but why don't I just put this thing in a syndication? I'm a big dog lawyer. I get offered this stuff all the time. And I really couldn't answer that. So I remember like in our morning runs, I would pepper you with these questions, right? I'd be like, why would I do this? Why would I not do this? As we started doing the POT dubs, as we started showing leverage, right? As we started showing this idea of putting down 25% on an asset and getting the appreciation for 100% of it, lights started coming on.
Yeah.
For me, right. So that to me was the first time that I was like, oh, I get this now. And then I started thinking, I see all these people doing it. I see Jen and Renee doing this stuff, right? Jen and Renee don't own their own home in Monterey. They're investing in rental properties. And I was sitting there with the idea that I could either wait it out and try to like buy a house. At the time, like I just started my company. My wife was a W2 employee. And I was thinking that, man, like we're either like kind of like saving and maybe moving into into a house that isn't like our perfect future house, or, it seemed a lot smarter if I wanted to like benefit from real estate to, instead of just going out and buying a house that I could barely afford, to just start putting that money that I had set aside to buy a house and for future investments into these cash flowing assets. And I wanted to get in the game. So I started asking you, man, does it even make sense that as somebody who is renting currently, that I get into this? And that's kind of how it all started, man. I remember you asking me like, well, talk to me about what you're trying to accomplish. Yeah. And I remember thinking, listen, man, I really think that I'm very impressed with Jacksonville. I've been on the other side of the equation in Miami where like things were affordable and starting to get unaffordable. And I started thinking that it's too late for this, or like, why would I buy for something at this price right now? And I knew that I wanted to keep up with, I wanted to invest in Jacksonville, and I wanted to like start investing in real estate and start getting those things that I kept hearing on the show to start working for me. And then at that point you were like, okay, well, if that's what you want, what do you got? And I had a 401k that at that point I wouldn't be able to just buy something, straight up cash out of like the old IRA. But I also had, I at the time I probably had about like, man, something along the lines of like 50 grand in a money market fund with Merrill Lynch that I had just like stocked away. That was part of my invested savings. And I probably had about 40 G's in the bank account that I like to keep for rainy day purposes.
Right. Yeah, I just remember that conversation of the primary home and and then the investment properties. And I think that's one that comes up sometimes. I know some of our clients sort of have to defend that action of like buying rental properties before you buy your own primary residence. And I wish it's one question that people would ask themselves more, right? Because if you live in a really high priced neighborhood, or you live in a really high priced market and in a really high priced neighborhood, there are so many good things that you can do with your money before you buy your primary home, and people feel like wrong about it. Yeah. But it is a very smart, wise financial move. It's been a really smart financial move for you, as we're going to see here in your journey.
Yeah. And I'd like to add one other context to that. It's you're in an expensive market and you're renting, or maybe you are in an affordable market, but you're in transition. Yeah. Right. For me, the reason why I didn't want to buy my forever home, but I still wanted to invest in real estate, even though I was living in that affordable market that I could have bought the home, is that I was in transition. Right. Right. So like, I believe that in this world right now that we are in the Zoom economy, right? Like we can live anywhere, and you're not really sure that you want to live in, I don't know, Port Charlotte, Florida for the next 10 years, or even Atlanta, Georgia. That's still a pretty affordable market, or all these different places. You can still invest in an asset that pays for itself. That's real estate, that doesn't hold you down, that if you ever do want to buy your forever home, at least you're going to be selling from real estate to real estate. and like getting that
Yeah,
upside.
I think to me, and I know we've got a lot to jump on here, so we'll kind of put a bow on the primary versus rental homes. To me, if you're buying your primary home, there's not a return on investment decision there, right? If you're buying a primary home, it's about what's the best thing for my family. Like I'm not putting a return on investment on that,
Correct.
right?
It's an emotional
It's like
decision.
this, I'm going to put down roots in this community,
Yep.
right? Those are the types of things that I think about when I bought my most recent primary home, right? Yep. You know, if that's not important to you for any reason, right? If your family doesn't need a, you know, new home, if your family doesn't need to put down roots in a community for whatever reason at that exact moment, if you are in transition, then you don't have to buy the primary. There's this beautiful opportunity for you to make your funds move in a more risk mitigated way, which is where we kind of landed for you on the investing in rental property decision.
Yeah. Yeah, man. So that was the first one, right? I had cash that was in a money market account and I was getting, I think like 2% on it or something like that.
Well, I did the research. It's even a little bit less than that.
Okay. All right, cool. And it was just sitting there and I knew I wanted to invest it. And I thought, all right, this is it. I remember heavily thinking, you're like, Pablo, you know, the best way to do this is to kind of like have a plan for getting to 3 so that your portfolio kind of balances out. And I agreed with that, but I also thought there wasn't a better place for me to put my money in general. And if I had enough savings for a rainy day, that sure, maybe the experience of like something happening in this property, the other one's paying for it, it's going to be different if it's coming out of my pocket. But I just saw it as, I intuitively saw it as like the safe bucket with upside that I, you know, before was just in a safe bucket with no upside. And I wanted to get in.
Let's start to share with the people all this good stuff that led to this client journey here. Yeah. So there's our boy right there. And these are the 3 properties that you purchased at the different times. So we've got 2 happened in 2021 and 1 happened last year. So the first property was that one on Minosa in February of 2021. Let's see, we started the show in February of 2020. So this is a year into doing the show.
Correct. Right. Exactly a year into doing the show. It took me about 9 months to read Rich Dad Poor Dad. Thanks Jen Filzen and Marilyn Cotterman for pushing me to do it, and Lee. And yeah, it was a year in. It was a year in.
And we were probably 6 months into twice a week runs.
Yeah, yeah. I would say, well, no, a little bit more. I feel like we started the twice a week runs in like April. Yeah, like it was like right after the pandemic hit. I was like, I need to make friends with this dude. Yeah. So. Yeah.
All right. So we bought the first one on Minosa Drive there, and we purchased it for $127,000.
Yeah, that's pretty good.
And at that time, people looked at those purchase prices and they said, "That's still high." Right? You still had people that were saying, "Listen, purchase prices are high. Like, why would I spend $127,000 on an asset?" This happened to be on the lower side of the pricing for you, but you know, these are smaller homes as well.
Correct.
In May of that year, we went back to the well and we bought this property on Lucky Drive.
Correct. So when I bought Minosa, I knew I was already, it's February 3rd, right? 2021, right? Like I already had in my head made, and we're going to talk about it in a second, but I had made this like investment in Peloton on February 2020 that was going crazy bonkers. Yeah, that was crazy bonkers. And I instinctively was like, you know, I can buy this first one because I think that I'm going to be able to like reach 1 year with Peloton, take some of those chips off the table, and
for tax purposes.
Yeah, correct. I wanted
That's
to
why
get
you wanted
past,
to wait a year.
Yeah, I wanted to wait a year to not get capital gain tax on cashing out of stock. And then I was going to be able to very likely buy another home and get to 2 at the very least. So I already kind of like had that earmarked in my head on how to get to 2. I didn't know how I was going to get to 3, but I was already thinking that, right? Which is why February this is bought, and then May, you know, we'll get into that linear story as soon as you want.
Yep. So we bought another one for $129,000, and then the third one here is the one that we bought last year, which is on Katina at $230,000. Right. And we'll get into the decision-making process there. But as I started to think about your journey here, it hasn't just been from Pablo, the, you know, incredible volleyball player, to Pablo, the, you know, community creator here and, you know, chief architect of vertical integration and all of that. It's really been just a journey from Pablo as what we would call an average investor to Pablo as what we would call a not your average investor. And thank you to Facebook and the Facebook stalking skills that I have, that I was able to go and find this little gem of a beauty. This is where Pablo, what's going on in this beautiful picture here?
This is 2009. It's the early days of Facebook. This picture was probably taken on a BlackBerry camera.
It's a little fuzzy.
And I had just moved back from California, and all my buddies from University of Florida were going to go tailgate the the Pepsi 400. And we all dressed up, because NASCAR.
God, did you know that it would be like the most perfect image of you as an average investor come 2023?
I didn't. In fact, I should probably go back to 2009 through about 2012 and maybe scrub a couple of images because I hadn't really conceptualized.
I don't think so. This show's gonna be going on for many, many years. I need some ammo. I've already downloaded all of them, by the way.
Cool. God bless.
So yeah, man. So it's been an incredible journey here. And as we're going to go step by step at each one of these intervals for you, we're going to take a step into your mind. What were you thinking? What were your concerns? What was the opportunity that you were seeking? And then how has it played out versus what if you had continued to do what you were doing before, which is going to be a lot of fun.
Yeah, I'm in. I want to answer a couple of quick questions in the chat. Number one is, there was one here in the chat that is, Lee Bishop is asking, are they 2-bed, 1-bath or 3-1? Lee, honestly, right now, I'm not really sure. I can tell you that my decision had absolutely nothing to do with a floor plan or what the house was. My decision was 100%, and I say this 100% earnestly because now we talk about this stuff, but my decision was 100% based on, I have this much money that I want to put in this kind of return, 100%. And I am very fortunate that I got to spend all this time with Gregg, with him explaining this to me. I got to spend all this time inside the guts of JWB, understanding that this is a truly special organization. And for me, it was like one part, okay, I'm investing this stuff in real estate, but I'm really investing it into this company that I just really believe in because of all the stuff that I know and see and whatever, right? But like, it really wasn't a 3-1, 2-1, anything like that. To this day, I think I think Menosa's a 3-1.
Sounds about right.
I'm not 100% sure, but for me, it really was a allocation decision, much more so than a house decision. And then Zach is asking us in the Q&A, aloha, Pablo, congratulations on becoming part of the JWB tribe, NYAI. As a new real estate investor, why is premium property management like JWB worth it? Mahalo. Zach, I'll answer that question in saying that, number one, at that point in my journey, I would not have been able to answer that question. Today, I can answer that question, but I think I did kind of answer that question just now in saying I saw myself as investing in a company that happens to be in an asset class. And I think that's how you need to see your property management, right? Like your return on investment and the thing that you are being promised is just an Excel spreadsheet. The ability to deliver on that promise is operational capacity. It is the ability to set a goal and steer a team forward in order to meet that goal. And that to me is a professional property manager does that much more so than Uncle Lou that's like, hey, I'm going to go plunge the toilet whenever it needs to happen. I'm going to go fill it in with a tenant before it needs to happen. I do believe that property management is the ability to fulfill on the promise much more so than whatever asset they put in front of you. Anything to add there?
Well said. It might sound weird if you're not a JWB client or you haven't invested in real estate, for a super successful investor like Pablo to answer the question of, answer the question of how many bedrooms or bathrooms are in a house, that the answer would be, I don't know. Like, to some people that feels weird until you put it in the context of how do you make other wise investment decisions, right? If you have a financial advisor, you do your due diligence to make sure that financial advisor is worthy of the trust of the hard-earned dollars that you're putting with him or her. And then you sit down, you map out a plan, and then that financial advisor puts you in assets that work for your goals. And you don't go to that company. If you buy shares of stock in a company, you don't go to that actual company and understand. A lot of times you don't even understand their financials, if we're being honest. You don't go and like ask their vendor relationships and, start to analyze, their contracts and things like that. So it feels weird. We are doing something different when we talk about investing with JWB when it comes to investing in rental properties. But at the same time, if you think about it in the context of how you become a successful investor, it's about the team. It's about that team or that individual that you placing trust in that team and then letting them do the investment for you, right? Letting them handle that investment for you. And they get to know all of those details. Pablo has no clue about what actual rent collection is on his property each and every single month. He doesn't know about the phone calls that our team has with the resident. All he knows is at the end of every month, rent comes in and he sees that in a report. And that is very normal if we think about how stocks and bonds work. So I love that we brought that question up. I really think that the investor at the end of the day prefers the type of relationship that you have.
Yeah.
Right. Even though as people who have owned homes, we think we have to know all of these details about the house. It's not what you want. And if you have a team that is worthy of managing your money well, it allows them to focus on delivering of the investment expectations, which is what we want.
Yeah, couldn't say any better myself. All right, GC. So this is my first investment. This is Minosa. Tell me what you did here.
So we went back in time in February of 2021, and this top section is if Pablo just kept doing what he was doing. And so at that time, his money was in a money market. Went back and money market returns largely track what the federal funds rate is at that time. And so I went back and I did an average of what the federal funds rate was from that time until now. And so it came out to about 1.7%. So while I don't know exactly what you would have earned, it's going to be somewhere around 1.7% on your money. If you had just kept your money there, your initial investment that you made in your first rental property with JWB had a down payment and closing cost of $28,575. If you had kept that money in that money market at earning 1.7% on your money each and every year since then, you would have returned a total of $944 for your total portfolio value be a little bit over $29,500.
Okay.
However, you didn't do that. All right. What you did is you put on a really spiffy suit. You put on a headset there. You got a nice mic and you became a not your average investor, brother.
I did, yeah.
You bought that first investment property. And here are the actual returns, right? By you stepping outside the norm, investing in your first investment property, even though you don't know how many bedrooms and bathrooms are there, right? You're not in the nitty gritty details, right? You had an initial investment of $28,575. You've been able to earn $9,239 in returns from that investment. So your current portfolio value of this property is over $34,600. Each and every year, your internal rate of return comes out to a shade under 9% on your money.
Awesome.
Yeah.
Yeah. What are those returns comprised of, and the portfolio value? What's the difference between those?
Well, I'm glad you asked. So the returns are made up of the 5 profit centers of rental property investing. So your net rental income, your tax savings, your principal pay down, your home price appreciation. And then the 5th one is inflation hedging and inflation profiting. You do have some of that working for you, although I didn't even count that into your returns there because it gets kind of complex.
Got it. And listen, I'll say this property has been the toughest property, right? This property had an eviction.
Yeah. I wanted to go deep into that.
Yeah. So I think that I love seeing this because this property is kind of like the property that my wife and I most speak about.
Yeah.
I'm glad I'm going to get to share this.
This is going to be great. Let's dive into what you've experienced as an investor, because I think there's a dichotomy between what people feel as a rental property investor versus what their returns say. And we can compare that to what they maybe feel as a money market investor, but what their returns say. Kind of talk about what you've experienced and then how kind of shocking this is to know that this is performed, call it, 4 to 5 times better.
Yeah. So what we have felt going through an eviction is a combination, not in order of fear, anxiety, and guilt, right? You definitely, I think it's really hard to own one of these things, know that there's all these months of, because this was one of those where your team for a while was they wouldn't pay for a month or two, and then your team would help them qualify for some kind of assistance, and then they would come up with the money and we'd get paid plus fees, right? So it actually would end up looking really, really good. And then, but we kind of saw the writing on the wall that this is a family that was going through some trouble, and eventually this would probably happen, right? So then that happened, right? Then there was a long eviction process where we weren't very certain of when we'd actually take control of the house or whatnot, because it's murky. I think it's harder to be in transition than it is to receive bad news or good news, Right. So that was painful. And then, it was the repairs needed to be done and the time of filling it, right? So that was a time where there was money coming out of our pocket, and that led to a conversation over the dinner table every single time.
Yeah.
So it felt like we've been losing money on this property.
Right.
Right. So like, it felt like we had lost a bunch of money on this property. And then now that it's filled and it's filled by a JWB, screen person, and we have like a contract on it for 3 years and we feel great. I felt like you were going to show me this and that one was going to be negative and I was going to be playing catch up talking about future pacing. So the idea that it is I'll share it again, right? Like the idea that, oh man, I'm just messing this up. The idea that I'm actually not just not playing catch up, but that my portfolio is worth more than if I would have kept it in Merrill Lynch is pretty eye-opening, right?
Well, and what do you think is driving that? Like, how is that possible? We know that your net rent, we haven't met your expectations as far as net rental income. You had an eviction early on, and it's hard. It's going to be impossible / really difficult to recover from that only owning it 2 years, right? Net rental income, we haven't performed, but there are 4 other profit centers, which is one reason why we love this. I mean, what's happened since 2021 that you just don't see and don't feel?
Home price appreciation, and not just home price appreciation, right? But like what we're talking about, preserving capital. Right. Even if it hadn't appreciated astronomically like it's done over the last 2 years, if this would have been in the stock market or something else, like chances that it could have been down or up
100%
are totally different. And yet I wouldn't have felt that. That would not have been a dinner conversation.
Right.
It would have just been like here's your statement from Merrill Lynch this month.
And even if it was, and we saw the statement and it showed that you were down 15%, there's almost a feeling like, well, that's what everybody else does. Everybody else is feeling that as well, right? You aren't the one who, did something different, right?
Correct.
And I think as rental property investors, these are really good conversations to have for you to share with everybody and for us to have, because you go through this emotional process. You're doing something different, and it's very hard to see the benefits of owning rental properties. And it's very hard to see. It's much easier to see the downsides of owning rental properties.
Yeah, totally. And Meg is saying in the chat, she had 9 evictions at one time last year, very challenging year, had to dip into savings. I get that.
9 evictions at one time.
Yeah,
wow.
I wonder if you were to do this with Meg's portfolio, and I don't think Meg owns 9 with JWB, right?
I don't think
I believe Meg does a lot.
Yeah, clarify for me. Those aren't JWB 9 evictions at one time.
But really surprised. I'm interested to see like what that looks like of like, what is the net worth that Meg has inside those 9 properties, and like what that is versus like what it would have looked like last year from 2020, late 2020 to like early 2022, and what the stock market has done.
It's like, even though I don't want an eviction for you or 9 evictions for Meg, right? But if we just look objectively at how your money is performing, withstanding all of that negativity, your money has been way more consistent and probably beat the returns of other asset classes, even though you've taken some punches here. And that needs to be understood more. It's like, even in its worst days in rental property investing, it is more consistent and generally has higher returns on investment, especially if you understand smart debt. It just is very hard to understand. It's hard to keep it top of mind. It's a mission that I've been on and we've been on largely because of this platform, is understanding how beneficial it will be to make this easier for folks like you and your wife and others to see how well this asset class is performing.
Yeah. Cool, man. All right. I want to get into the ones that I feel really proud of.
Cool. All right. Well, there's the one. 8.8% is what we've been able to do, even though you went through an eviction on that one.
Pretty cool. All right. So this is my favorite one, the storyteller.
Yeah. Right? Let's talk about this one.
I like, so my second one I bought, I think when Robinhood first became a thing, my buddy Nitin Sharma, shout out to Nitin, he was like, dude, there's this app, you can trade stuff for free. I was like, all right, cool, whatever. I started messing around with I put like $1,500 in an account, started messing around. As the community guy, I look for specific things in specific stocks to gamble on, right? Like I look for, is the amount of word of mouth coming from something unreasonable, right? AKA, why is every Chipotle I go to packed? Yeah. Right? At whatever time. I look for, is there some kind of community element that they're doing? And are people Are they being the stage? Is there some kind of like shared economy that people can base some kind of like little business on, or is there some kind of way that I can promote myself through it? Because I really believe in that stuff, right? So early on, I put some money in Shopify, put about $1,000 in Shopify, like 2016. By 2020, that $1,000 in Shopify was like $7,000.
Nice.
Right. And then I'm sitting around and it's like late January. I'm hearing about this stuff coming out of China, this COVID stuff coming out of China. And I'm like, man, I wonder what's going to happen in Shopify if like supply routes get disrupted. Because this thing, at that point, we just thought I was going to stay in China.
Yeah.
Right?
Maybe a few supply routes get disrupted.
Yeah, maybe a few supply. And then at the same time, Whitney Ritchie, famous from the show, became like the 17th bajillionth person to try to sell me a Peloton because she wanted me to like do rides with her and join her WhatsApp channel and blah, 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 blah.
Right.
And I just kind of put two and two together. I was like, man, this thing has crazy word of mouth. It's kind of the shared economy for fitness. And if this China thing is worse than I thought, then more people are going to be like working out from home and buying this thing. So I took the $7,000 from Shopify and I put it in Peloton. And like 3 weeks later, the world shuts down. I don't think about it for about a week. And that Peloton thing starts going nuts.
Yeah.
Right. So like I'm looking at it every day and I'm just like, man, oh my God, this $7,000 is not $12,000. Oh my God, the $7,000 is not what, like, and I'm thinking the whole time, I'm like, dude, I need to like, this is going to be great. I think this is the next great company. But as my like thinking starts maturing and I buy this property on Minosa, I'm like, how am I going to get my next one? And I immediately was telling you, I was like, I think I want to cash out. I thought I was going to keep going up. I was just going to take some chips off the table,
right,
and then buy it and then stay in Peloton and keep writing it out. And what ended up happening was on the year, like right at the year, was kind of like right when like the COVID bubble of all these things started bursting, and it went from like, I think I wrote you, right? I bought Peloton at like
lost a bunch.
I did, but I bought Peloton. I think I sent you something like at 12 bucks a share. I ended up selling it at like 122 a share.
Yeah.
But at one point it was at like 143.
Yeah, I remember it was even higher.
Yeah. So that thing ticked down. And then I was just like, man, do I just cash this out? Do I wait for this to come back up? And I was like, you know what, man? At that point, without the language, I was like, I'm going to preserve capital. Right. Like I'm going to take these chips off the table. I'm going to buy the second home. I don't want to wait any longer. So I cashed out the Peloton stock and I bought this home.
Yes, you did.
Yes,
and let's see how this thing looks. So if Pablo kept doing what an average investor would do, and he kept that Peloton stock since May 17th of 2021 until now, it wouldn't have looked good, brother. It wouldn't have looked good.
What's I'm looking up the Peloton stock ticker right now. Peloton is at $8.21 a pop, right?
There you go. I looked it up yesterday, and the markets were closed yesterday. It was $8.64, so it's even lost since then. Your initial investment of $29,025 in Peloton stock since then has lost $26,308 for a current portfolio value of $2,717. That is a 69.4% negative IRR.
Yeah. And that would have been down from this like valuation, but really I put 7 G's in a Peloton. So I still would have lost on the initial investment, but the pain of like, that would have been a real loss to me that I would have
that would have been crushed.
Yeah. And I think about like my buddies in my chat that we're all just day trading all the time, like holding on to it. All those games, they don't talk about day trading anymore.
Yeah. Yeah. No.
Right? Like they stayed in all these, like the casino stock that they were in, the Zoom stock that they were in. Some had Peloton. Richie has a bunch of Peloton, right? Gotcha. Yeah. But yeah, so anyways, this one I'm particularly proud of because it took a certain level of discipline to take cash off the table.
I agree, dude. I agree. You were being a not your average investor by doing that, because at that time it was this, we were in an environment, there was so much money in our economy. Share prices were so high relative to what earnings were. They were just off the chart. And as we know now, a lot of that was just false. It was, demand pulled forward for products and services, and, the age of easy money, which led to inflated stock prices, which is a part of Peloton's story. But it wasn't so clear at that time. You were the oddball by pulling out of Peloton. Correct. And then going into rental property.
Correct.
At that point.
And Kelly says in the chat that this is a classic case of like a non-diversification, right? Like lack of diversification example. And I 100% agree with Kelly. but I also subscribe to, I've said this a couple of times on the show. I subscribe to the thesis put out by Nassim Taleb not that long ago in his book, Black Swan, where he talks about, and this, I guess this reflects a lot on what we talk about on the show, but he talks about the idea that in this like interconnected world, there's going to be more and more black swan events,
Sure.
right? Black swan events being things that happen that change the course of history forever that you couldn't have seen coming, but then you can justify on the back end. And he believes in this idea of having a 85 to 90% portfolio that is in very, very safe things with very, very high floors, and then betting 10 to 15% of the rest of the portfolio on things that expose you to positive black swans, healthcare sciences, technology, stuff like that, right? So I believe in that. I really do believe in that, right? And I just thought before that meant, 85 to 90% in like bonds and the S&P 500 that has X, upside and floor, and then the rest to gamble on. So this was my gamble money.
Right. That makes sense.
This was my upside.
This was not how you were preparing for retirement.
Correct.
Right.
And that was why I was perfectly fine in like non-diversification and like betting on things based on me thinking I'm smarter than I am.
Makes sense.
But the flip side of that equation is this idea that I now very much believe that it is in my best interest to have at least 50% of that 90% in rental properties, right? Because because I find it to be as safe or safer than bonds and the S&P 500 with more upside than what, like you average out the bonds and the S&P 500 to be.
I love it, man. I hope more people see it the way you do, because I really think that this, this volatility that people deal with on stocks and, bond, we've even seen volatility in bonds lately over the last couple of years. You don't have to just accept that. Yeah. There are other asset classes that you can also enjoy the experience of being an investor in. And I hope more people open up their eyes to rental property investing and others, because it can be a bumpy ride. But as we look and see how this actually turned out on 71 Lucky Drive, this is your second JWB investment property. This thing's been a home run. How's the conversation of Lucky Drive for you and your wife? It's all kind of lumped in together.
It's all kind of lumped in together, man.
Okay.
Like Minosa has definitely tainted the conversation at all.
Yeah. Makes sense.
For sure.
So Lucky Drive, your initial investment for JWB in terms of your down payment and your closing costs, that same $29,025, except you've returned $17,430 as a byproduct of those 5 profit centers for your current JWB portfolio value to be over $43,000. Your return on investment, your IRR over these 2 years roughly that you've owned it is 21.7%. That means you've earned 21.7% on your money each year for these 2 years. And instead of a portfolio value of a little bit over $2,700, we've been able to grow that thing to over $43,000, brother.
Not too shabby. Also, renewed lease, right? Like they re-upped. We got another like 2-year lease in place. So still haven't had a turn. It came with a credit.
Oh, cool.
So it's doing pretty well.
More along the lines of what a typical investor experience is for JWB. Your average duration of residence stay is 4.5 years. And so that's what we're expecting for this one on Lucky Drive for you.
Yeah. I love it, man. This is a good one. So it has been, by the way, this was a POTW.
This was, oh yeah, that's right.
You remember that?
Yeah, I do remember that.
I was like, 71.
I mean, how could you not? It's Lucky Drive. I wish every name was street name was named something like this.
You played right into my gambling sensibilities, but you put that right in front of my face. All right. So that's number 2, right? That was a little bit further from the beaten path, right? I just took some stuff out of the stock market and in, but it wasn't the traditional stuff in the stock market. And, like I really, really happy with this one. Third one was way different. Like this, at this point, things got weird.
Yeah. Do tell.
Right. So at this point, I knew that the window was closing on the opportunity to lock in low interest rates.
The deal of the debt, baby.
The deal was the debt. And we talked about it for a really, really long time. And I knew that there was a closing window for that. And I also wanted to get to that third property that we preach about, that you've told me a lot about, this idea of like diversifying my real estate portfolio. So and it was when we first started, everything started going bananas on like in the news about there's a recession coming, right? So this was the end of 2021, right? Yeah, because I bought it in July 2022. Oh no, it is July. Yeah. So July it was the end of 2021. I saw that I had this old IRA that had about 100 grand and change in there. And the first blip happened. The first blip where that 100 grand and change went down to about 90 G's. And I guess I had the muscle memory from the Peloton stock of thinking, hey, there's always a shot across the bow before the big thing happens.
Mm-hmm.
And I remember thinking, all right, I've got this thing there. I don't have enough to buy a property in cash and contain it inside of my IRA if I went self-directed. What about if I just cash this thing out? Like, would I be able to just pay the penalty, pay the taxes that have been deferred, pick up another rental property and avoid whatever was going to happen in the stock market and just lock in this debt that has my leverage working for me at like a 14 to 17% based on the shows that we had been doing and whatnot. I went to my financial advisor and I was like, hey man, I'm going to do this. And he's like, you're crazy.
Yeah.
Wait till I publish my newsletter. That's all about time and market. And I'm like, okay. He's like, it's coming out tomorrow. And I was like, okay, I'm going to give it 24 hours. I read the time and market thing and I was like, this is no different than the time and market that I want to be in real estate.
Yeah.
And in real estate, it's going to be higher.
Yeah.
So I went against his best wishes, cashed it all out, broke his heart. I don't know if he's still my friend, and then decided to move forward with this home, which was the most expensive one that I've purchased. But I also, again, I look at this in buckets. I was like, hey, this is my last time for a while that I'm going to put in this bucket. So I had the opportunity to buy this home for like 221 or a home that was like 160 that was also on the market. I decided, you know what, I'm going to pull forward demand and I'm going to just overinvest into this bucket because I know that this is the bucket that's going to set me up for the future while I mess around with my business and other things that are more active and more high risk, high return. So I pulled the trigger.
It was an incredible move. It was something that you approached me and said, hey, this is what I want to do. And we talked through the numbers of it. And if you believe that interest rates were lower than they're going to be in the future, and if you have a buy and hold mentality, and at the core of this, what you said is you wanted to be in a different, better asset class, then you were going to, and if you thought that the market was probably not on exactly stable ground, all those things from a different perspective make sense as to why somebody would actually pull money out of their 401k or their IRA and to accept those penalties, and why you would still, wind up with a better return on investment. I will add though, that you do not have to take the penalty. It made sense for Pablo in this case, but for all of you out there, many people have the misconception that if you invest with your 401k or with your retirement accounts, that you are forced to take these penalties or forced to pay the taxes on it. That is not the case. It made sense for Pablo here, but there are a number of strategies that you can do something similar to what Pablo did here without incurring those costs and those penalties.
Yeah. And Kelly's asking me in the chat, what led to me deciding to cash it out versus buying in the self-directed IRA? What I can tell you, Kelly, is I was afraid of having enough capital in the self-directed IRA to contain the investment inside the self-directed IRA. And at the time, the thing that really seduced me was the debt. And the debt that I could get on a conventional loan versus a non-recourse loan was very, very different. I really, really wanted to lock in long-term this historic smart money that I wanted to leverage. And that's the reason why I did it.
That is the greatest decision that right there, the debt is the reason why this was such a great decision at that point in time. Right. Yeah. And you're going to look back in 5 years, 10 years, 20 years of owning this property. And you're going to look back at the interest rate that you got and you're going to go, wow, that was awesome. Even though in the short run, it was very likely that this was not going to be a better return on investment in the first year or 2 years, simply because we had a 10% penalty that we had to overcome. And, you've got other things that kind of weigh down the investment right off the bat. So it was all about the long-term, brother.
GC, you want to break down what this means? So here's what I'd like to do. We're coming up on time. We still have 65 people. I'd like to break this down. I want to answer all the questions that everybody has, because I think there's some really good questions for us to talk about here.
Right.
And then you can share the overall outlook on my portfolio and how I've done versus other things.
So here's what we've done. So Pablo's third property on Katina Drive here, he hasn't owned it for very long. And when you start to run IRRs, unless a client has owned a property for, 2 to maybe 3 years, it's counterproductive to run run an IRR. And we can go more and more into that if we have time. But ultimately, we don't produce IRRs for client portfolios if they haven't reached kind of that 2, maybe 3-year threshold. So Katina is only 1 year in, so I don't have an IRR to report here, but I do have your initial investment, which is $69,575. Your total returns from all 5 profit centers of $34,362 for a total current portfolio value over $91,000. What I can tell you is, even though we don't have the nifty little IRR calculation because of the short amount of time you've owned the property, you're shaping up really good on this one.
Yeah, feels like it.
And comparing that to what you would have done, it's great to see that you would have done quite well in the S&P 500 as well if you had kept it in that 401k.
Yeah, true.
Right? You just happened to, you would have earned a 16% IRR if you kept it in from that time. The market was depressed at that time. It has since gone up, which is great. You would have been in a good spot there, but long-term, this decision is going to be paying dividends more and more and more the longer that you hold on to it.
Yeah. And, to me, the big thing here, being that it was my 3rd property, right? Like whatever I would have done in the S&P 500 was less valuable to me than the idea of having the 3 properties that I could rapidly pay down one with the cash flow of others and get to the point where I could take debt out on the equity of the existing properties to buy myself more properties.
Right.
So like that S&P 500 return was not going to spawn other S&P babies.
Exactly.
Whereas like, to me, this idea of having like the 3 homes and like the equity that you gain and then being able to like play the financial engineering game and the leverage to then buy other homes a la Hervé Francois is what I was really trying to accelerate.
Love it, man.
Cool. All right. So we got some great questions here in the chat. I'm gonna in the Q&A. I appreciate you all using it because it allows me to keep track of this better and kind of pace this better. So I'm not gonna take them in order, but Tamara Gameson, happy to have you, Tamara. I love that you're here. I love that you're asking questions. First show, she's asking, can you share the list of 5 profit centers again? Tamara, I would explain the list of 5 profit centers as cash flow, right? The one that everybody talks about. Gregg likes to talk about it as far as risk mitigation. If we can get to break even to positive cash flow, then that allows you to not have to dip into savings and not, it makes it so like the bad moments aren't terrible moments. And that way you can stay in the game a long time to get the rest of the profit centers. Number 2 is debt pay down. That is your resident living in the house, paying down the debt. You're gaining equity from that month over month. 3rd is the tax savings, right? By being able to depreciate the cost of the building materials inside the home, you get these like tax savings that you normally wouldn't get. And it's the type of tax saving that you don't have to pay something to then get a write-off. It's just a write-off. Then there is a murky one, then there is the one that really, really moves the needle, which is home price appreciation, which is the reason why we like to invest in high growth markets with positive cash flow, because home price appreciation at the end of the day, particularly paid with leverage, is the one that builds a ton of wealth. And then there is inflation hedging. The idea that you are not losing ground to inflation is also a profit center that we talk about that's been more and less interesting as time goes on.
And Tamara, anytime somebody has a great question like that, I think it's a great opportunity to encourage you to get on the phone with my team, because these 5 profit centers are so foundational. It's hard to just give a little bit of an answer there and give you everything you need. But that can be that first, call it half-hour conversation where we can walk you through how powerful these 5 profit centers are for rental property investing. So just go to chatwithjwb.com, chatwithjwb.com, set up a time, and team happy to walk you through that.
Yeah, I love when the class that we talked about in the beginning, the big takeaway in the class was like build your network. And there's no better way to build your network than to just like hop on and like pick the brain of the category king of rental property of turnkey rental property investing, right? Like it's that first call is really just like a get to know you and figure out if this thing is for you and ask all the questions that you may or may not want to ask here. But love to have you keep coming back and asking great questions. Vinod Badami. Vinod, welcome to the show, man. That's a new name. That's a new name.
Welcome to the party.
Love to have you, Vinod. With the recession coming, won't the home prices in Jax take a hit? So how does one preserve their capital and top that with high rates? GC, I think this is a question for you.
Great question, Vinod. Many of the smartest people in the room believe that a recession is coming. I happen to agree. You look at the financials and the economics and just the state of the world right now, and it's hard to see where we don't land in some form of a recession at some point. It's really interesting. Many people first think that when you hear recession, that means real estate values are going to go down. When in reality, real estate values in 5 out of the last 6 recessions have actually gone up in Jacksonville. And so the outlier would be if home prices actually go down, which the one that most people think about is the Great Recession when home prices went down. But that one is an outlier. And we spend a lot of time. In fact, there's a number of shows that we've done specifically on this. I'm thinking of probably like the last real estate market update. Did we go into that one? Or maybe it was the previous one?
Probably.
Yeah. Vinod, I would just encourage you to go to our YouTube channel and you'll see some shows that we've done a deep dive on recessions and how real estate prices actually work. But the way to wrap this up would be home prices are actually quite resilient in recessionary times. The Great Recession was an outlier. You know what's not resilient in recessionary times, Pablo?
Stock market?
Stock market. The average decline of the stock market in recessions going back since World War II is a 29% decline. That's in the S&P 500. That's the average. The best that the S&P 500 has done in any recession since World War II is a 20% decline. And many people are way overly dependent on the stock market for their retirement income, their other investments. So I would really be worried about the more traditional asset classes taking a dip. I will add one more thing. Even if there was a dip in real estate prices, I've lived that. I started to invest in 2006. I had 40 rental properties as a 23-year-old. I had a lot of debt for those 40 rental properties in 2006, 7, 8, 9, 10. So I lived through the Great Recession. The best thing about single family rental properties is if you're investing for the long haul, if your home value actually did go down, it didn't matter. It didn't matter to me. Rent prices are very consistent. Rent prices year over year have actually never gone down nationwide, even during the Great Recession. So this is built to be a long-term hold. And that asset class, this asset class of owning rental properties is a lot more consistent in recessionary times than other asset classes that people are heavily invested in.
But if I was to add anything to that, when it comes to preserving capital, and at least how I think about it, I take a step deeper and go, yeah, sure, the stock market's going to take a dip 20% or to 29% on average during a recession. But I also know that there's some stocks that do well in a recession, right? Like auto parts stores do well in a recession, stuff like that. And I also know that in real estate, there is risk mitigation and then there's risk mitigation. And I see specifically to these homes, the way that I made this decision on this portfolio and how I would do it going forward, these are workforce housing in a growing market. And the reason that matters is because when it comes to workforce housing, the socioeconomic class that needs workforce housing is always going to need workforce housing, right? It's always going to be like the best living condition that they can have based on their wages that are of teachers and of Amazon workers and all these folks. And then there's also the people that live a little high on the hog when the economy is doing well. And they go to luxury condo rentals or go rent something by the beach. When the recession hits, those folks come to workforce housing, right? So the idea that this is a risk mitigated thing during a recession because it has the base, really strong base in Maslow's hierarchy of needs. And on top of that, it has if something happens, I go back to this. It's kind of like that AutoZone stock. It's kind of like the people that AutoZone does X because it has enough people that need to do that. But they also, that person that was going to go buy a new Mercedes is not going to go to AutoZone and try to fix it for themselves during a recession. So I just think that plus the idea that this is in a city that's growing gangbusters because it has an unbelievable quality of life and a weird level of low cost of living is also going to be a risk mitigated piece when it comes to this one specifically and how I think of it.
I love it, man.
All right. So here we go. Let's go. Lewis.
I think we're going to have to go rapid fire here.
Let's go. Rapid fire. Lewis Huddle, do you still want to buy a primary residence? And if so, what would factor your decision to allocate funds towards primary residence as opposed to another investment property? Lewis, I do want to buy a primary residence. I want it to be in Jacksonville. My thing has been that as an entrepreneur, I've been building a business, not exactly building my income while my wife has been supporting us as a W-2. And I'm incredibly grateful for that. My business right now is starting to take off. So the moment that my wife and I combined are able to buy something within a 5-minute drive of Gregg, because I have to be close to him and the beach, then I'm in, right? But until we can purchase the home that we really, really want, where she has an art space and I have a content studio and I got that golf cart lifestyle to the beach, I'm waiting. Jim Kirko has a question. This is the Kirkos in San Diego.
Love it.
Did you have you have two generations listening? We love it, Kirkos.
Amazing.
Family of the Not Your Average Investor Show.
Love it.
Would you give the same advice to 50-year-old father as a 20-year-old son? What would you say, GC?
No, I wouldn't give the same advice to a 58-year-old father as a 20-year-old son. I think that's where, effective planning of your portfolio comes into play. I think everybody has a different plan. And, it's one thing where we can talk about the best ways for us to grow your money, but if that doesn't fit with where you are in your life, then it doesn't matter, right? We want to keep a space for what creates peace of mind for you, or if you don't have another source of income now, right? How are we going to build this to make sure that we have more income coming in quicker? So I think we would build the portfolios differently. However, generally, what I would tell either the 58-year-old or the 20-year-old is to think outside of the traditional ways to invest, because the traditional ways to invest are volatile. And it doesn't matter if you're 20 or you're 58, if there is a better asset class that is more consistent, that also has better long-term growth, it at least should have a seat at the table in your investment portfolio, no matter what age. And many people just turn a blind eye to that. So whether you're 58, 88, or 20, the sooner that we open our eyes to an alternative asset class like real estate, the better your portfolio is going to be. And ultimately, the more in control of your financial future you will be.
Real quick, lightning round. The one thing that I would give advice to a 28-year-old or a 58-year-old is that I think that we got to stop looking at portfolios as growth or cash flow. I think there is the idea that you can look at a portfolio as cash flow growth portfolio.
Yeah.
There is a way now that you can implement real estate as a passive investor so that it's not like, man, I got to get all these stocks and then I'm going to retire and then I got to live off of whatever those stocks are doing. I think that there's a way to just maximize for the amount of cash flow that you have that continues to grow when you are in retirement, because we are retiring at a slightly later age, but living way longer. So you got to really, really think about what your cash flow is going to do over time when you're in retirement.
And I would just say, Jim, it would be great for you to reach out to the team and bring your 20-year-old son on that phone call and start to do some of that planning. I just had the opportunity to meet with a client, and his son actually used to work for JWB, and we together were building a portfolio for his dad and then also for his son. And awesome. You're never too young to learn. So
love that. Love that. And we love young Kirko watching the show, man. I'm jealous that I wasn't thinking about this stuff when I was your age.
Me too.
All right. First, the patriarch of the first family, Ken Moline. How did you evaluate your properties setting in our 4 workforce neighborhoods? Ken, I just bought properties. That's it. I didn't really evaluate it. To me, these are widgets. Stevie B, with regard to primary home ownership, do you recommend using home equity line of credit to make a down payment on a rental? If so, is it possible for the cash flow to cover both the rental mortgage and the line of credit playback? That's for you, buddy.
At this moment, it's usually not a wise move to use your home equity line of credit for the down payment of your rental property. It can be if it's a very short-term move and you have a way to replace that capital. But at the end of the day, taking out the debt of the home equity line of credit, which has elevated interest rates right now, on top of the debt that comes with your primary mortgage, is going to put you in a negative cash flow situation. So if there isn't a short-term fix to that, meaning like you're going to get a bonus or an inheritance to pay off that HELOC, then it's usually not something that we're going to put you in that position. But like with everything, right? There's more to the story. And I would encourage you, who's that? Stevie B in the house.
Stevie B in the house.
Retirement, Stevie B there. It's a good opportunity for us to sit down and put the plan together with you, Stevie.
Awesome. The legend of Hawaii, of the Hawaiian Islands, Zach Correa asks, aloha, Pablo. Knowing what you know now, what is your investment strategy going forward? Throughout your JWB journey, what would be the one advice that you would give a new rental real estate property investor? For me, it's not necessary to do extraordinary things to get extraordinary results.
How cool is that?
Oh man, I love getting any kind of advice I can get from Zach because I want to be him when I grow up.
I know, right?
So what is it? What is my investment strategy going forward? Zach, I want to continue. My investment strategy going forward is cash flow growth portfolio. Like I really want to be looking at where I'm putting my chips in a way that will continue to generate cash flow as it matures, not get to a certain point and start having to like milk cash flow from it is the best way that I can put it. And then throughout my journey, what would be one advice you have to give to new rental real estate property portfolio? Get in the game. Like I really, really, really believe in the idea of stop. And I've made this mistake. I made this mistake for 15 years. When do I buy real estate? When should I wait? Should I go? It's not when do you buy real estate. It's buy real estate and wait, right? Like the sooner you get into real estate, the more those 5 profit centers start making magic for you while you chill.
Love it, baby.
All right, cool. Eddie Harris from Atlanta. In the self-directed IRA, you need to pay 50% of the cost of the house. Yes, Eddie, that was one of the reasons why I could buy it conventionally financed with the haircut, then not do it and not have enough to keep in it. Medj Garcia, Medj, I love having you here. What are the dates for the campus tour in 2024? I guess she's talking about the IRL.
The meetup.
Yeah.
We haven't set those. I was just asked that by somebody else as well. So we gotta put that together. You know, it'll probably be Q1-ish of 2024. Yeah. So I think we gotta put that together there, buddy.
You don't need to threaten me with a good time, buddy. All right, Tom Hall, last question. This may have been answered, and if so, my apologies. But if I only have 13K in a 401k to leverage, is it possible to get much done with that? I'm going through your courses now, but wanted to ask here. Thanks for the great info, Tom. First of all, thank you for taking the course, dude. We love the fact that you're doing that. I appreciate it. We put so much work into it. You answer that question.
I love it, Tom. It's just amazing that you're taking all these steps, being here, being in the course, asking this question. The reality is that $13,000, it's difficult, but it's not impossible to get started, right? You know, I started at 23 years old and I didn't put any of my own money into a deal. So there's those strategies is what we would need to focus on with you. You know, at a minimum here, you're going to need a little bit more capital than that to do either private lending or to do owning of the rental property portfolio. Think about $20,000 as a minimum to get more into a private lending type investment and more around the $75,000 range to actually own the asset. But I would still encourage you to reach out to the team, right? To be here on the show, because like I said, you can get started here. If money is the reason why you're not investing in rental properties, if that's the only thing, that with a little bit of expertise, a little bit of experience, a little bit of mentorship, that honestly is the easiest problem to overcome, right? These are great assets and there are other people that will get value from a partnership with you, and other people have money that they don't know what to do with. And so you can create some value for that partnership, and you can create a way for you to get started, even if you don't have much of your own capital.
Great question, Tom. And by the way, that's advice that Gregg has given me a bunch of times, right? This idea of like, maybe you got credit and somebody else got cash, or maybe you got cash, somebody else got credit. There's always a way to do it, man. Jim says, thanks for answering the question with him and his son, and that he started the process with jwb.com. That's awesome, Jim.
Love it.
Love it. By the way, I love Jim's name. It sounds like a Hall of Fame first baseman.
I feel like Jim Kirko was on the mound when I caught those foul balls earlier today, right?
Jim's got that baseball player name, man. All right. Nadeem Shah says, how much does the Fed charge if one sells their 401k? You pay the taxes that you had deferred, and then you also take like a 10% penalty. Yeah,
pay 10%. But again, you don't have to do that. And I'm going to be shedding more light on how easy it is to take a loan against your 401k. We're going to demystify some of the myths out there of how it can be something that you have to get penalized for and whatnot, because I think that is an asset right there that a lot of you have access to that is at risk because many of you have too much in the stock market at this time. So cool. You can do it without penalties.
Kelly, our favorite fiduciary fee-based financial advisor, says ordinary income plus 10% penalty under 59.5 years. Quick question from Serge Borbos, who has a call scheduled with jwb.com. So good stuff, but he wanted to clarify with you in here. In the last show, you had mentioned that you can take out a loan of up to 50% from a 401k without penalty. This does have a max of 50K, at least in my 401k account. I thought you mentioned 250K. Can you clarify if the max is 50K, or is it possible to get more out?
I can clarify. There is a max of 50K if you are taking a loan against the 401k that is with your current employer. There are also strategies to move and reallocate a lot of your 401k dollars into a different retirement vehicle, which will give you more access, which would not technically be a loan. So there's a whole lot here when it comes to unlocking your retirement account, getting better diversification, building a better retirement account. I just think that's going to be a talking point for a lot of us on the show, I think for a long period of time, because people just don't know the opportunity that they have. And quite frankly, I don't think they know that the risks that they have by keeping all their eggs in the more traditional basket. So Serge, awesome to hear from you. Serge is a longtime client. Would encourage you to reach out to the team, but simple answer is there is a max of 50K or 50% of the value of your 401k that's with your employer.
Got it. All right. GC, You ready to give me the final diagnosis?
Let's do it, baby. They've waited until the end here.
Yeah, love it.
All right. So we package this all up and we put it together here, and we'll go to the next slide, Vanna. And here is how we have performed, right? So this strapping young lad there, looks like such a not your average investor, has his initial investment with JWB with $57,600. His current portfolio value is just about $78,000 for a total return on investment of 15.1% year over year, the last 2 years. Your expectations were 12% on your money. Mm-hmm. And, the reality is that it hasn't been exactly perfect. Mm-hmm. But at the end of the day, there's nothing better than taking care of the money for one of my best friends and knowing that, you've made some really good decisions, and I think the best is yet to come.
I love it, man. And, I gotta point out the whole Pac-Man, right?
Same thing, right?
The Pac-Man is always real. When you look at the pieces of the pie, when it comes to the wealth that you are building, people obsess over cash flow. Cash flow isn't even here. Right? Like that barely even have cash flow because of the eviction and all that stuff.
Exactly.
But I've been able to break even. And at the end of the day, what I'm really building my wealth on is this green Pac. It's green, Greg. It's a green Pac-Man here that makes up almost 68% of what my return's on. And where I see these things is this means that in a couple of years, pay down a little bit more appreciation, I'm going to be able to pull out this equity and invest in more rental properties and more real estate asset classes at an advantaged tax position that's going to then create that infinite returns. And that's what really jacks me up, man. I'm really pumped about it.
Can't wait to do future shows where we talk about not just the 3 that you have, but how you've been able to multiply that into 4 and 5 most of the time without bringing additional capital. It's certainly possible.
Yeah, man. And listen, this is the time of the show when I say, I cannot believe that we've had 70 people on this whole time.
That's great.
61 plus right now, an hour and 20 minutes into a work week. And usually I just thank you for being here. But on today's show, I really think that what's really apt is I would not have been able to do this if it wasn't for the support of this community, right? Like the social cognitive dissonance is a real thing, right? Like cognitive bias.
Okay.
Cognitive bias is a real power. And if you can surround yourself with people that are doing things that you want to do, but you consider extraordinary, all of a sudden they become normal to you. Mm-hmm. And there's just no way. There's no way, right? Like I've faced a lot of, my dad wasn't on board with this. My wife was questioning at first. My best friends that I consider smarter than me and more successful than me were like, nah, there's this. And I just really, really would not have done this if I didn't get to spend the time with you, Greg. So obviously a big one goes out to you and the rest of your team, which has shown me the light. But more than anything, just this hearing it week over week of Lee and Drew and Jen and Medj and, and Nadeem jumping in and Richie coming in and telling us the deal is the debt, right? The more you hear this stuff, the less you can unsee it and not go on with it. And that, at the end of the day, it was a giant game of very positive peer pressure for me.
Yeah.
So I just thank this community for everything that it represents and being able to do this. So,
everybody just loves you so much. I mean, there's a reason that people are staying an extra 20 minutes longer. And that's because there's so much love for you, what you brought to this community, man. So thank you all for being here. Thanks for supporting our boy here. It's been incredible. Pops, you have created this platform for so much wealth to be created. And these have been turbulent times in the last 3 years as an economy, right? So to create this platform, this love where it's okay to be doing something that's different is really, really special. I know that this journey has been really fun for me and you as best buddies, but as a financial resource for you, it means a lot to know that you put your trust in us, that we're here, we're performing. And, I just can't wait to see where it goes from here, brother.
May the record show that we weren't best buddies when we started this. This has been a documented love story.
It has been. I don't know if there's ever been a documented love story more than this, by the way.
And I love to see, and you know what, man, I look forward to the day that we put the numbers together of just all the wealth that has been created from people watching this show.
That's coming. I'm going to do that.
I'm really pumped for that, man. So listen, join us on Thursday. We got a guest investor coming in. It's going to be another great story, another great reason for cognitive bias to happen for you. But more than anything, if you want to make these decisions, they're not normal, and you just can't think like an average investor. See you next time.
See you.